Investing in the stock market can feel excessively risky. In fact, for many young people, particularly those fresh out of college, the world of investing can feel overwhelming and terrifying. And when statements like investing is just like gambling or you're just throwing your money into a risky game, the misunderstanding can keep people from taking the first steps toward building their financial future. However, investing and gambling are fundamentally different activities. While both do involve risk, their goals, methodologies, and long-term outcomes couldn't be more different. In this video, we'll explore 5 ways investing isn't gambling and why embracing these distinctions matter for your financial growth. Number 1, building wealth versus winning big. Intention matters between investing and gambling. When you invest, you're aiming to grow wealth over time by acquiring assets like stocks, bonds, or real estate. These things have intrinsic value and the potential for long-term appreciation. In true investing, when you buy an asset, you're not just placing a bet on a random number, you're buying into a company or product. You analyze its financials, understand its business model, and evaluate its growth potential. The better your research, the more informed your choice is, and that's not a gamble, that's strategy. Gambling, on the other hand, is inherently speculative. It often relies on luck or winning big in a short amount of time. At a game of chance, the odds of winning over a long period of play decrease over time because the longer the player plays, the more they're expected to lose as the house gains advantage. Games of chance might qualify as investing only if you own the casino. With gambling, you have a near 100% chance of losing your money over time. You might hit a jackpot once in a blue moon, but the long-term expectation is negative. Investing is about taking calculated risks for sustainable rewards, while gambling is about risking money for the chance of an immediate, uncertain payoff. Number 2, control over outcomes. When you gamble, once you place your bet, you have no influence over the outcome. Whether it's a roll of the dice, spin of the wheel, or deal of the cards, it's entirely up to chance. When you invest, you have control over your choices. Firstly, you can decide what you want to invest in, be it an industry or a specific company. You also have the ability to determine how diversified you want to be based on how much risk you're willing to take on. And the most important part of investing, you have the ability to adjust your strategy based on economic trends, personal goals, or any other external factors. Investing, when done correctly, takes a long-term view based on informed decisions. It's a slow, steady climb. Oftentimes boring, but by continuously educating yourself and making informed decisions, you can tilt the odds in your favor by the choices you make, something that's impossible in a gamble. Here's another choice you can make. If you're enjoying the video so far, please consider liking and subscribing to the channel so we can keep helping others learn more about personal finance. Now let's look at the third difference between investing and gambling. Number 3, risk management and diversification. One of the biggest indicators of whether you're gambling or investing is your ability to manage the amount of risk you're taking on. In investing, this is done by diversification. When you spread your assets across different asset classes, think stocks, real estate, ETFs, you reduce the impact of a single poor-performing investment. For example, we're generally advised to hold both stocks and bonds because they tend to be inversely related, meaning when stocks are having a bad year, bonds typically tend to go up. This can help stabilize your portfolio and offset some losses. Additionally, we're advised to hold funds instead of individual stocks because broad market index funds like the S&P 500 offer us exposure to hundreds of companies. So if one company has a really bad year, the others in the fund can help mitigate the risk and loss of that one stock. Gambling typically requires placing all your money on one outcome. We saw this in the early 2020s with the cryptocurrency and NFT space. Many people threw their life savings into one crypto or another hoping to strike it big, leaving no room for diversification should that crypto not hit. As an investor, you can diversify your portfolio, invest in low-cost index funds, and stick to a long-term plan. These approaches help you to manage risk effectively, an important consideration for anyone hesitant about investing due to the fears of losing money. Number 4, time horizon. So you've made your investment, bought your funds, now you pretty much leave it alone for decades. That sounds boring, but that's exactly the point. Another key difference between investing and gambling is the role that time plays. Investing, done correctly, takes away the excitement of jumping in and out of market positions. It drains away the adrenaline rush that's also associated with gambling and makes it clear that this is different. When it comes to investing, patience is rewarded. The market may have ups and downs in the short term, but historically, it has trended upwards over decades. Gambling's outcome is generally immediate. You either win or you lose. There's generally no opportunity for gradual growth or recovery from losses. When you throw 20 bucks into a slot machine, all you can really do is hope that you win. But that's a big hope, since the odds are usually not in your favor. Investing operates on the principle of building wealth slowly and steadily, whereas gambling is a one-shot game. Number 5, cash flow and value. Investing often shifts your focus to income-producing opportunities, such as dividends or rental income. When you invest in the stock market, you're providing capital to a business or an asset with the expectation that it will generate income or appreciate in value over time. In the same way, investing in real estate as an opportunity for rental income provides someone else a place and benefits you with both property appreciation and income. Investments in both the market and real estate have consistently yielded positive returns over time, creating opportunities for both investors and businesses to profit. Of course, there's no such thing as a guaranteed investment. Risks are an inherent part of investing, but successful investors rely on their own financial education, risk-taking ability, hard work, willingness to learn from failures, patience, and positive attitude to make the best decisions for themselves and their families. So why does this matter? Understanding these differences is critical for overcoming the fear of investing. The narrative that investing is just gambling prevents so many people from taking advantage of opportunities to build long-term wealth. But by recognizing that investing is a calculated, goal-oriented process, you empower yourself to make decisions that align with your financial goals. Remember, gambling is a shot in the dark with hope that it turns out profitable for you. But once that shot is taken, there's no way to impact the result. Investing is about creating a roadmap for your future by making informed financial decisions. By embracing investing early, you can harness the power of compounding, build wealth steadily, and take charge of your financial destiny. Are you getting started in investing? If you're new to investing, here are a few tips to set yourself up for success. 1. Start small. You don't need a fortune to begin. You can start investing with as little as $5. 2. Learn the basics. Take time to understand key concepts like compound interest, index funds, and diversification. Getting familiar and understanding these key money concepts will help you understand how it impacts your financial life. 3. Invest for the long term. Avoid get-rich-quick schemes or speculative trades. Steady growth beats flashy risks, so when you decide to make an investment, ask yourself, is this a product I'm ready to support for 20 more years? If it's not, then be cautious. 4. Seek advice as needed. If you feel you need a little more information, or if some concepts still feel unclear, don't be afraid to work with a financial professional. By treating investing as a disciplined, long-term journey, you can avoid the pitfalls of speculation and build a solid financial future. Thanks so much for watching. We hope you learned something new today. If you enjoyed the video, give it a thumbs up and share it with a friend. And we'll see you in the next one.